Thank you. Good morning, everyone. So first off, a brief outline of my presentation of what we're going to see in the coming slides. We'll look at 4 different topics in this presentation. So firstly, we'll see how mobile operators' business case is evolving currently, in particular how they're adapting to the new all data-driven world and how they cope with the regulatory and market pressure on the traditional voice and SMS-centric revenue models. Then we'll turn to the core issue of smartphone wars. We will observe how the pecking order in the industry has been turned upside down by the arrival of let's call it the modern smartphone, or some call it the superphone. We'll also look at the next frontier for smartphones, i.e. lower cost, likely highly commoditized devices for emerging markets. We'll also finally try to gauge the survival potential of various protagonists in the ongoing smartphone wars and have a look at how that correlates to their stock market performance. And just to finish with a little peek into how markets perceive the NFC opportunity. So the first check, how are operators doing in the brave new world of smartphones? Service revenue trends are mixed to negative at the moment. There is substantial pressure on operators' voice and SMS revenue coming from regulation, from competition. Traditional voice had a minus 8% contribution in Q2 for the aggregate European operator revenue, and that hasn't much changed in Q3. This is essentially down to price pressure, which is competition and mobile termination rates related, but growth in volume of minutes is also slowing from plus 4% in Q2 to plus 3% in Q3. Data, on the other hand, compensates partially for the voice decline to the tune of plus 3% in growth contribution terms. Excluding the regulatory pressure, service revenue growth is positive, but still slowing to below 2%. Given the current macro environment, it is important to highlight the correlation to GDP growth for operator revenue. And the 08-09 period showed a revenue to GDP elasticity factor of 0.5 times, meaning that the 1.6 percentage point cut in GDP for Europe we have seen between June and today may translate into a 0.8 percentage point cut for operator service revenue. This is somewhat worrying for the industry, of course, since both infrastructure spending and subsidies of high-end smartphones are highly correlated to operators' revenue health. However, the fact that data at least partially saves the day for operators and it is therefore a priority for them is certainly positive for mobile broadband investments of operators. Now let's have a look at how the mobile device industry changed during the past 10 years. This chart depicts the mobile phone profit shares at the operating level and includes both smartphones and non-smartphones. Until the emergence of the iPhone, Nokia, which is the green area at the bottom, reigned supreme in the old-school smartphone arena with a unit market share of 50 to 60% in smartphones and an overall mobile phone market share in units of 40%. Nokia's overall mobile phone industry profit share in EBIT terms peaked at 60 to 65%. That was last seen in Q2 08. I think it's only fair to say that Nokia's smartphone domination was achieved with a very different class of devices versus what we have today. They were essentially glorified feature phones. With Apple's launch of the iPhone 3G, the landslide of incumbent players started in Q3 08. Fast forward 3 years later to today, and you can see that Apple and Nokia traded places, with Apple dominating currently 2/3 of industry profits, while Nokia is crushed to a negligible entity. Others, such as Motorola, LG, and Sony Ericsson, have also seen their profit share disappear and never truly recover, so there was basically no back from the dead in this industry. Nokia is attempting this resurrection today with Windows, and with Microsoft, we're going to see that later, I hope, although with considerably larger resources than previous casualties in this highly competitive market. Now, since I have the pleasure or the questionable honor, given the current market circumstances, of being the voice of the stock market on this panel, here goes my share price chart of this presentation. With this chart, I hope you're able to understand why equity markets monitor very closely smartphone competitors' operating profit share. It is an excellent measure of how an individual vendor stacks against the rest of the world in this fiercely competitive market. With high profitability, a vendor can secure more ambitious R&D and marketing roadmaps, invest into its ecosystem and its operating system, secure large quantities of crucial components at the best possible price, and so on. And so you can probably understand why Nokia's share price tracked so closely the vendor's share of the overall industry profits over the past 10 years. The peak in 2007 coincides with the last moment when Nokia commanded colossal 2/3 of industry profits, and 4 years later today, Nokia's market capitalization has shrunk by a factor of 6 as its industry profit share almost evaporated. You can also see that the predictive power of equity markets is not that great, and Nokia's share price actually moves bang in line with the company's weight in total industry profits, and the share price actually doesn't anticipate anything in this case. And now for a quick look of where the smartphone market is going at present. As you can see in the left-hand bottom chart, smartphones as a proportion of total overall phone sales have surpassed 50% in end 10, early 11 in mature economies, Western Europe and North America, and are currently closer to 60%. As these saturated markets, with overall handset sales barely growing in unit terms, it's only natural to now assume that these markets have already seen the best of their smartphone growth years. All eyes should now turn to emerging markets. Only 20% of devices sold there are smart. The top chart on the right shows the distribution of smartphone market growth by geography. In 2009, mature economies represented 2/3 of the total growth, and emerging markets rose to half of total growth in 2010, and this year, emerging markets are dominating total growth by capturing 2/3. For example, Western European smartphone growth stalled to flat, slightly down actually in Q3, just reported, from 50% growth earlier in the year. North America also slowed to 20% growth in Q3 from 70% growth in Q1. Meanwhile, the APAC market, which is the largest and most important one, continues to more than double year on year every single quarter this year. In order for smartphone growth to continue in emerging economies, we need to get the price-demand elasticity to do its job over time. This is a common pattern in consumer electronics, and smartphones at an unsubsidized price of less than $100 are needed. Indeed, most emerging markets are largely unsubsidized due to low ARPU. Chinese suppliers and Samsung will reach these price points in mass market volume of Androids in 2011. And now on to the more difficult question: how many operating systems will actually survive? Let's first contemplate one simple fact. The smartphone market is getting towards an annual run rate of 500 million units. This is very large, more than the PC market, with very entrenched and sticky ecosystems. Unlike the plain mobile phone market, where vendors compete on perceived brand equity, design, and feature sets, smartphone vendor must convince the incremental new buyer of the superiority of its ecosystems versus what's already in the market. And this is getting harder and harder as more consumers have already chosen and started investing their own money in established ecosystems. This is why, at least when it comes to North America and Western Europe, we believe that smartphone ecosystem wars have been fought and have been won by Apple and Google. There's no question whether these two guys are here to stay. The question is rather, is there a good reason for any other ecosystem to survive in the long term in these geographies? Now, looking specifically at Nokia, Symbian is wound down to zero by 2013. It will be interesting to watch whether Nokia can actually convert a meaningful portion of its historical user base to the Windows platform. This will be a tall order given the Windows Phone 7's current very small 1.5 percentage point market share overall. In our estimates, we give Nokia credit for its brand equity in emerging economies, which leads us to assume that there will be a recovery of the Windows Phone platform share from 2013 on, but Nokia's ability to drive costs down with Windows Phone 8 will be absolutely key here for the platform's longer-term viability. As we've seen previously, Android vendors will be more than ready with a commoditized cheap smartphone as well. And finally, RIM's future is in balance. The transition to BBX, derived from X, carries very substantial execution risk, and the company's recent track record is poor. Now back to what we do best, talk about stock prices. Here we go. Of course, we only talked about one tiny aspect of global technology, smartphone strategies. But I think we can say success or failure in this particular niche is of paramount importance for the equity market's valuation of individual protagonists' overall potential. We compiled here a list of smartphone giants. In many cases, they're significantly diversified outside the smartphone arena, of course. And let's have a look at the correlation between these smartphone leaders' share prices and what we can qualitatively say about the success of their smartphone strategy. You can clearly see that the equity market rewards a successful smartphone strategy deployed by the winners, Apple, Samsung, to a lesser extent Google, on which the jury is still out whether they're actually making any money or just preserving their core business by investing heavily, then giving away for free their Android OS and ecosystem. At the other end of the spectrum, you've got Nokia, LG, and Research in Motion. Clearly the failures of the year. They have been punished by 40 to 70% drops in their market value year to date. And HTC, the jury is still out there. Perhaps they're on their way out of the winning camp as the company's market share gains are stalling in the current quarter. And to conclude, a quick peek into how equity markets see the NFC opportunity. We see huge interest on behalf of investors in the technology, but struggle to find listed stocks that have meaningful exposure to it. Gemalto, Ingenico, and Verifone are a couple of stocks that are most commonly used as NFC proxies. However, this is a very new technology, and there is lots of misconceptions around it that we list in this slide for you. There's little clarity in investors' minds with respect to the distribution of value, go-to-market strategies, lots of confusion in sorts. Therefore, as you can see in the chart detailing Gemalto's share price and the NFC-related news flow, the stock market reacts in an erratic and often a simply wrong way, showing that lots more education of investors still needs to be done on this subject. This concludes my presentation. Thanks very much for your attention.